There is an old saying in the market, never go against the trend. Today, there is only one core trend in the crypto market, that is, an unprecedented torrent of capital is violently washing over an asset class with extremely limited supply. This extreme imbalance between supply and demand is causing waves in every corner of the market. Tonight, we will take a deep look at this head-on collision between capital and scarcity and what it means for your portfolio. Today, the story of Bitcoin is no longer a simple rise and fall, but a vivid macroeconomics practice class. The core is, funds are pouring in at an unprecedented rate, while the output of Bitcoin remains unchanged. Let's first look at the demand side. For the first time, the US spot Bitcoin ETF has achieved 2 consecutive trading days with a net inflow of more than $1 billion per day. This is the first time since the launch of the ETF. Throughout this week, more than $2.7 billion of funds have poured into the Bitcoin market through the ETF channel. Demand is exploding, but supply can't keep up. Matt Hogan, Chief Investment Officer at Bitwise, pointed out that on Thursday, the Bitcoin network produced only about 450 new Bitcoins, while the ETF purchased nearly 10,000. Data from another institution, January 3, also showed that the demand for ETFs was 22 times the daily supply of Bitcoin. This huge gap, as Samson Moe, CEO of January 3, said, at the current price level, this demand is unsustainable, implying that prices must rise to balance supply and demand. This imbalance is directly reflected in the price. This week, Bitcoin hit a record high for 3 consecutive days, breaking through $112,000 on Wednesday and rising to $118,780 on Friday, with some quotes even hitting the $120,000 mark. A long-term mathematical model called Power Law shows that Bitcoin's current price has been ahead of its long-term growth curve for 2 years. Analysts point out that historically, whenever the price is so ahead, it indicates that the market has entered a parabolic rise phase of extreme greed. If history repeats itself, the model predicts that Bitcoin could reach a range of $200,000 to $300,000 around Christmas this year. More notably, Bitcoin seems to be decoupling against the backdrop of uncertainty in global trade brought about by the Trump administration's tariff policy. While traditional markets fluctuate due to trade frictions, Bitcoin, on the contrary, is seen as a tool to hedge inflation and geopolitical risks due to its scarcity and decentralized properties, and has taken an independent upward trend. For investors, the current core logic is very clear. The massive and continuous buying brought by institutions through ETFs is colliding fiercely with the low supply of Bitcoin after the halving. This creates a strong upward momentum. At the same time, the narrative of Bitcoin as a macro hedge asset is being verified by the market, which has attracted more long-term capital seeking safe havens. While Bitcoin has absorbed most of the funds and attention in the market, the world of altcoins is staging a fierce debate about the protagonist of the bull market. Is the altcoin season coming? This is a polarized topic. Some analysts believe that the altcoin season has begun or is about to come. They pointed out that Ethereum rose more than 17% this week, and XRP soared 26%, indicating that funds have begun to overflow from Bitcoin. The other faction is more cautious. Analyst Matthew Hyland pointed out that despite the rise of altcoins, Bitcoin's market capitalization dominance, BTC dominance, has only slightly dropped from 65% to 64.46%, barely sneezing. This shows that most of the market's funds are still concentrated in Bitcoin, and the real altcoin bull market may not yet come. The market is currently at a delicate balance point. Bitcoin's strength has laid the foundation for the entire market, but whether funds will rotate to altcoins on a large scale and continuously remains to be seen. Here are a few cases worth paying attention to. XRP's strong rise this week is driven by whales. On-chain data shows that the number of wallet addresses holding more than 1 million XRP has just hit a record high of 2,743. These whale addresses currently hold a total of 47.32 billion XRP. This large-scale on-chain increase is regarded as a very positive signal by the analysis platform Sentiment. Technical analysts believe that once the $2.90 resistance zone is broken, XRP may quickly move towards its long-term goal of $3.40 or even higher. Dogecoin's performance this week is a textbook case. Under the overall positive sentiment of the market, Doge once surged nearly 9% intraday. However, when the price hit the resistance level of $0.213, it encountered a large-scale sell-off and the price quickly fell back. Analysts believe that this is a sign of systematic profit-taking by large holders. This reminds investors that for meme coins driven by retail sentiment, they need to be vigilant about the risk of whales smashing the market. There is an interesting paradox here. In the second quarter of this year, tokens related to NFT projects, such as Pudgy Penguin's Pengu, rose an average of 55.4%, making it the best-performing sector. But at the same time, the transaction volume of NFTs themselves plummeted by 45%. Analysts believe that this reflects that speculation is shifting from NFT images themselves, which have poor liquidity and high prices, to related tokens that are more liquid and can be traded on exchanges. Under the hustle and bustle of the market, the undercurrents of politics and regulation are equally turbulent, which is crucial to the long-term development of the industry. The most eye-catching news today is that Bloomberg quoted anonymous sources as saying that Binance, the world's largest exchange, wrote the source code for the stablecoin $1 associated with the Trump family. The report implies that Binance is deeply involved in the creation, promotion and even market value management of the stablecoin. Binance founder Zhao Changpeng responded fiercely on social media, calling it a black article with a lot of factual errors, and threatening to sue Bloomberg for defamation again. At present, the incident is still a matter of opinion and lacks substantive evidence. The background of this storm is that heavyweights in the crypto industry are actively seeking a pardon from President Trump. Following the pardon of 4 former BitMEX executives and Silk Road founder Ross Ulbricht, former Binance CEO Zhao Changpeng, former FTX CEO Sam Bankman-Fried, and recently Bitslato exchange founder Anatoly Legadimov have all applied for or been reported to be seeking a presidential pardon. It is natural to link these things with the issuance of the Trump family stablecoin $1 on Binance. In addition, the trial of Roman Storm, the co-founder of the highly watched Tornado Cash case, will officially begin next Monday. At the final pre-court meeting, the focus of the prosecution and defense included, the judge plans to focus the trial on the operation of Tornado Cash as a for-profit website rather than its crypto-mixing technology itself, and whether the data extracted from the mobile phone of another co-founder can be used as evidence. The result of this trial will have a profound impact on the legal liability of decentralized software developers. In short, today's market presents us with a complex and exciting picture. On the one hand, institutional capital is pouring in with unprecedented force, reshaping the value foundation of Bitcoin and mainstream crypto assets. On the other hand, the altcoin market has both opportunities and risks, and the game of politics and regulation has also added huge uncertainty to the market. For investors, seeing the main line of capital flow and being vigilant about the fundamentals and potential risks of specific projects will be the key to navigating this bull market. That's all for today. Thank you for your company.